Morning, ladies and gentlemen. Welcome to our special show, Top Stocks, where we discuss quality shares which could be in the limelight in the next 6 to 8, 10 months, 1 year later, mainly because of an event that has happened recently. This event could be an earnings upgrade, it could be a major corporate development, it could be a merger or a demerger, anything and everything that could unlock shareholder value over the next 1 year, 18 months. First, the disclaimers. This is not an invitation to buy or sell that share or that sector. This is merely an update to the latest developments that are happening in quality stocks in the immediate term, which might present an opportunity to add them to your portfolios over the longer term. If you wish to take a position, please consult an independent financial advisor. And one more thing, I have no trading or delivery positions in the stock that is going to be discussed. With that background, ladies and gentlemen, let's show you the long-term chart of Vedanta. Vedanta is India's largest diversified metals and minerals conglomerate. It has businesses in aluminium production, zinc production, energy, which is oil as well as gas. It has a business in copper, zinc, and of course several other metals. The reason why we are discussing Vedanta today is that it has won shareholder approval earlier this week for demerging its main businesses into separate listed entities. For every one share of Vedanta that you will have, you will get a share equal of Vedanta Aluminium, Vedanta Oil and Gas, Vedanta Power, Vedanta Steel and Ferrous Metals, Vedanta Base Metals, and the residual Vedanta, which has Hindustan Zinc in itself. This demerger has won shareholder approval and is most likely to take place in the first quarter of FY26. Now, let us examine the 5 businesses that Vedanta has. You have a background as to why we are discussing Vedanta today. Let's look at the earnings that Vedanta had very recently announced. Sales rose 10% year on year in the quarter gone by to 39,150. They have risen both sequentially as also year on year. Net profit was up 76% to 4,876 crores versus 2,868 crores a year ago. It slipped marginally over the second quarter. Now, the reason why Vedanta, which is a commodity giant, wants to demerge its commodities business into separate listed entities is because it feels that the sum of the parts valuation, that is, if you separately value aluminium, zinc, energy, power, ferrous metals, and the residual business will be more than the market capitalization of 1,58,175 crores. So for shareholders, they will be benefited by either looking at specific businesses they want to invest in and avoiding the rest, and also if they hold on to the complete stock of 5 shares instead of 1, they will realize a higher market capitalization than what it is today. At least that is the logic that has come in. The revenue is 1,48,000 crore rupees on a trailing 12 month for Vedanta. So it's a huge revenue generation machine, and the earnings are about 12,874 crores over the last 12 months or so. When you look at the individual breakup of performance, both aluminium and zinc individually contribute 41% of EBITDA each. So 82% of Vedanta business comes from 2 main entities, which are the aluminium business as also the zinc business. Oil and gas, it had earlier purchased listed company Kane Energy that contributes about 11% to its EBITDA. International zinc business about 3%, iron and steel about 3.2% of EBITDA, and power about 1.2%. Now, because it's a commodity play, Vedanta is at a lower price earnings multiple of about 12.3. The price to book is 3.7. If you look at the 5-year history of the price earnings multiple, it's fairly close to its median. 12.29 is the current PE. The 5-year median PE is 8.26. The stock Vedanta is still available at about 25 to 26% below its all-time high. If you look at the 10-year PE of Vedanta, that's also fairly close to the median PE. Current PE 12.2, and of course the 10-year median PE is 9.45. Price to book is also somewhat similar. If you look at the 10-year price to book on Vedanta, it stands somewhere like 3.73 versus the 10-year average of 1.46. When you look at the investment rationale as to why this demerger is being done, it's fairly simple. Vedanta is likely to have lower debt in the coming 2 or 3 quarters, and it is also likely to post its highest ever EBITDA in FY 2026. That's the demerger year. Debt reduction is going at a fairly strong pace. The average cost of interest is now at 11% versus 13.3% that was there about 1 or 2 quarters ago. Until August 2025, this 11% will also come down to 9.5%. So you can see at least a 350 basis point cut in the cost of debt, which itself will release a lot of cash flows, which they again will be used in the expansion of aluminium, in the expansion of zinc facilities. So this is the background, ladies and gentlemen, as to why we are discussing Vedanta today. Remember, these are painful moments. These are times when everything is bleeding red and bleeding blood, but this is the time when you should be looking at quality large cap stocks, which may over a period of time provide you with a sustainable wealth creating portfolio. Of course, there are investments risk in this business. Let me highlight them as well. Of course, because it's an aluminium producer, and aluminium prices over the last 1 quarter or so have been on an uptrend. That is the reason why the company announced such a sharp rise in its 3rd quarter profit. However, the risk is the raw material aluminium, the ore, its prices may rise. There could be a rise in debt for various reasons, we don't know. There could be a fall in the prices of finished metal, which is aluminium and zinc. Remember, put together, they contribute 41% of EBITDA each for Vedanta's financials. And of course, there could be failures in the exploration of oil and gas. And finally, Hindustan Zinc, the cash cow of Vedanta, could see a small or a medium decline in the demand for its metal, domestic demand for its metal zinc. So with this background in mind, ladies and gentlemen, keep Vedanta on your radar. Keep looking at the stock price, which is now 26% below its all-time high of 520, available at somewhere like 400 rupees. The demerger should go through over the next 3 months or so, and you will have 1 share each of the 5 businesses that Vedanta has. There could be some of the parts valuation that could exceed the current market cap. Please also consult an independent financial advisor if you do decide to look at Vedanta seriously as a part of your long-term portfolio. Thank you for watching. Have a nice day. Good morning, ladies and gentlemen. Welcome to our special show, Top Stocks, where we discuss events which have led to some of the finest shares in the market.